Hi everyone, and welcome to another episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan, and on today's show it's me talking to you about last minute tax saving things you can do. So we're quickly approaching the 5th of April here in the UK as I'm recording this, and I'm hoping to get this to you in enough time so that you can at least take some action to get these last minute tax saving tips. So in this one, I've just got a checklist I want to run through and just talk about in a bit of detail around what you can do. Like all of these things with accountancy, some of it's going to sound a bit repetitive in that I'm going to say to you, investigate this, check this out. And the main reason is some of these things I can't advise you on and say, you can definitely do this because I don't know your situation and I'm professionally regulated, so I don't need to be careful. But what I can do is point you in the right direction and say, look, I think you can go do your research, because some of these things you could research and you better find instantly that they're for you. And some of them, particularly around things like pensions and that kind of thing, you're going to need to probably seek some advice if you're not sure, because it's a detailed and a regulated area. So let's get straight into it. So let's get going firstly with the biggest tip of them all. Then if you've listened to any content I've done for any amount of time, you're going to know this. And I'm going to say to you, keep good records. If asked what is the best possible, the GOAT of tax saving tips, what would it be? I would say to you, keep good records. It's so easy to lose a receipt and then lose a tax deduction. You know, you're out traveling for business. Let's just say it's qualifying travel. We won't get into the rules. And you go in there and you put your hand in your pocket. You've got some cash and you buy that sandwich and that coffee for you for your lunch that day when you're out traveling, right? As a potential tax deduction, you lose the receipt, or you don't pick it up, or you don't ask the cashier for it, because a lot of people don't even give them by norm now, and then you've forgotten about it. That money you've spent has been taxed potentially twice. You know, as a sole trader, you could have paid income tax, national insurance before you've got that money in your pocket to use. And as a limited company, you might well have paid, corporation tax and then some sort of income tax, what most people would refer to as dividend tax, but it's income tax on that money to have paid it. Whereas if your company or your business in the sole trade example had paid for it, it would have been before tax. So it actually adds up to a massive a saving over the year or a massive loss in the amount of things that you might have lost by not doing these kind of things. So absolutely, you've got to have a look and think, how am I keeping my records? And as we go into the new tax year, how can I get better at it? So for me, I mean, you can see behind me on the shelves and things, we're massive advocates of cloud accounting software. And for us, the market leader in that is going to be Xero. If you did want to get on that journey of getting yourself into a cloud product, now there is something called Making Tax Digital. And again, we've done shows on this and we'll absolutely be doing some more content on this one because it's not going away, where sole traders are going to have to report effectively 5 digital tax returns a year from April 26 for many people. You're going to need to be in one of these products or something that can submit electronically anyway. So now is the time to be thinking about it. And if you do want to get on that journey, we actually have, surprise, surprise, a discount code you can go to. So if you go to heelanassociates.co.uk/0, you can pick up some crazy deal there for, I think, 6 months at the minute for some ridiculous amount of time price. So go and do that and get yourself on that journey. So keeping good records, absolutely the first tip. Now then, if I was looking more wider, the first thing I would say to you, particularly if you're a new business, is think about your personal allowance. So here in the UK, you get about 12.5 grand, if we're keeping it rough figures, every year that you can earn income from all sorts of sources without paying any tax. And most people, that's going to be eaten up in either your day job or it's going to be eaten up with salary from your limited company or something like that. But you do find situations, particularly around this time of year, where an owner, let's say they've started a business, maybe they've got a redundancy payment in the back end of the previous tax year, and then they've lived on that money and they haven't really thought about it. And it's almost criminal, it feels criminal from a tax planning perspective to not make use of that personal allowance. And therefore, you've got to just think about it. Have I got, I mean, this one should be fairly obvious to you. But it's not always, have I actually got any income on paper this year? And it's particularly relevant, and it sort of merges into another tip. If you have a limited company, think about your director's salary. So normally as an owner director of a limited company, one of the key tax planning points is you'll normally have some sort of salary, normally to around the level, particularly from April, normally around the level of this 12.5 grand personal allowance that will see you through and get you a decent corporation tax deduction. It's worth over £1,800 for most people, this corporation tax deduction. It's really important. Now, the reason it's doubly important for a director is thinking about that you need to get a state pension qualifying year. So these kind of all meld into one big thing. And it's almost, and I think we have done videos and podcasts on blogs on this in the past, plenty of times, but you need to make sure that you're earning, if from one source, around, if we just call it 6.5 grand for ease, in the, as we're talking, this is specifically, although I don't think it changes into next year, around the 24, 25 tax years. These are last minute things you can do in this tax year, but they apply most tax years. So having a think about that and thinking, have I earned at least 6.5k-ish on paper? It's not quite 6.5k, but just this easy figure to use, and utilising that. So you've got two things. Am I using my full personal allowance at 12.5k generally, whether I'm a limited company, whether I'm a sole trader? And if I'm a limited company, have I got, if the answer to the first one is no, have I at least got 6.5 grand of salary in there? And just thinking about that. Now, you might have an employed job that is eating up both your personal allowance and this 6.5 grandish figure I'm talking about to make sure you lock in what's known as your state pension qualifying year. You need a number of those years, 30 odd plus, to actually get your full state pension. So that's why it's important. So looking at those two things, that is probably the number one gap we see with new startups, is they just haven't considered that. And then they've missed out on, they're probably paying £1,800 plus extra corporation tax than they needed to, and missing out on a state pension qualifying year, and got no income on paper, which doesn't help when you want to go for a mortgage or something like that. So have a look at those things combined. And that is absolutely a key area. Now, as we're recording this and as you're listening to this, you haven't got a lot of time left in the tax year. So that one you've got to jump on if you're a director of a limited company that needs a payroll, because most payroll departments are having a very busy time. I know ours are absolutely rammed at the moment with trying to do all the year end. And again, people coming to us asking us for these payrolls to sort out. And of course, we'll facilitate those. But it is a busy time of year. So just make sure you investigate it in really good time. Now, having a look at some more kind of mundane stuff that everybody could do. If you're looking to make gifts to charity, now's a good time. So gift donations, for example, they call them gift aid donations. It's just a mechanism that exists. But basically, when you donate to normally registered charities who have got part of this scheme, they will say, do you want to make a gift aid donation? And you can declare those on your tax return. Now, you don't really see a benefit of that until you're into the higher rates of tax. So 50k plus, just call it again, using round numbers. But it's still worth recording. And it has interesting interactions basically with your tax return, particularly at 50k plus. So if you're thinking, my income is probably going to be more than 50k and I did make some charitable donations, or you want to make some charitable donations, now's the time, and just look for that gift aid. When they talk about gift aid, you want to make ones that have got gift aid on it. That's possible. Now you're looking at that. Then you're having a look at things like, okay, am I married? there's a good one. So if the tax system's a bit archaic in some ways, that marriage is quite a concept in quite a few of the reliefs. And there's something called marriage transfer, where you can basically transfer some of your personal allowance. That first thing we talked about, that 12.5k a year roughly that you can have tax free. You can take some of it and you can transfer it to a spouse. It's a fixed amount. So there are some pitfalls with that fixed amount, and it doesn't work. And this is the biggest thing. It doesn't work in a situation where one of you's over 50k-ish. You're in what's known as the higher rate of tax. So one of you's paying the big rates of tax, one of you's not for various reasons. This most commonly happens where you have, for example, one person out earning and the other one's potentially a primary childcare, or they've got multiple small jobs or something like that for various reasons. And then you don't end up with you can't do it in that circumstance, because otherwise everybody would do it. It's such a common scenario, that one in a general kind of UK household, that people would do it everywhere. So that's restricted. You can't have one of you in the higher rate of tax and it work. So the chances of this being relevant are a lot sort of narrow in scope than you might think, but it is worth checking out. So if you're married and you neither of you's in the higher rate of tax or earning over 50 odd K, just think about, could one of us benefit more? So for example, you might have somebody that's not earning any money in the household. And maybe they're just at home for whatever reason, and the other person's earning, say, 20, 30 grand. In that circumstance, it might be positive for you. And there is a claim form you can do online for that, or you can go personal tax account. I'd always advocate for people to get one of those. We're going to need them more, particularly as business owners, which is always the content of these podcasts and videos. So just think about that and see if it's relevant for you. Definitely usable in the right circumstances. Now, talking niche things, again, it's everybody's possibly could use this, but you need to be in a situation where you want to sell what I call the big stuff. So things like you've got a rental property to sell, or you've got some, but more likely you've got some shares or some crypto or something like that you want to part with and make a profit on. And there's something called a capital gains annual exemption, an allowance every year that basically says the first £3,000 of profit you make on those items is going to be tax free. That used to be really high, used to be over £12,000, but they've slashed it over the coming tax years. It's only a mere 3,000, but it's still quite useful. So if you're thinking, look, my shares have done quite well, I was going to cash some in, now's a good time to think about potentially doing some now before the 5th of April. And it doesn't matter whether this is you personally, so whether you're an owner, director of a limited company, or you're a sole trader, or you're a partnership, doesn't matter, this is you personally. Maybe do some this side, use your 3,000, and then potentially sell some others the other side for using another 3,000 allowance, because it's the same into the next tax year. So it's just a small planning point. worth thinking about. It used to be much more exciting to talk about when it was 12 odd grand if you had anything substantial. So we had people, for example, selling buy-to-lets, and they were maybe lowering their portfolio a bit. So they had multiple flats. They would do one flat before, at the end of the tax year, one at the start of the next year, and just time it well with the conveyances so that, you use allowances in either tax year. So think about that with your capital gains allowance if you're doing the big stuff. And then while we're talking about big stuff in the business, so that was you personally, in the business, this tip mainly applies if you're a limited company with a year end in and around the 31st of March, because your limited company year end doesn't have to run with the tax year. It could be anywhere, but particularly works very well with sole traders and partnerships where your year end is going to be the tax year end at this point. And that is thinking about, do I need any more equipment? If you were running, you running laptops all day long and they're a bit old, or you've got equipment, maybe you have camera equipment, or you have other things that you need to refresh. Now's the time to be thinking about buying them. And the reason being is there's two things. If you're a limited company, then you're going to end up with something quite often called annual investment allowance, or the use of what's known as capital allowances. And that means quite often, if it's a piece of equipment like a laptop or something like that, you'd actually be able to get your entire tax relief in one go. So if you bought a laptop, you better write the whole value, even though it's going to last you many years, the whole value of that laptop is going to come off your profits and therefore reduce your tax bill. Now, we've talked about this many times in other videos, in that I would never say to you, go out and spend money just to save tax. We've done loads of podcasts talking about this and other videos talking about this. And there's a good one where we talk about what does tax deductible actually mean. And it's a good example of why you shouldn't just spend money to save tax. But in the right scenario, it's really, really good. And now, like if you're thinking, I'm going to go and buy these things in the next couple of months, just bring it forward. That's the general idea, because you're going to spend it anyway. It's just, if you think about it, if you buy it now, it's going to impact your next tax bill. It's almost like the worst time to buy something would be like the 7th of April for a sole trader. So this tip works. We talked about capital allowances and annual investment allowance and some of these things that get this treatment working in a limited company. In a sole trader, it can work like that. I don't want to get too deep into it. I think we did a podcast talking about cash versus accrual basis, but it depends how you do your tax return. Now, either way, it's likely to be the same result. So you're going to get your entire allowance, we're using that laptop example, off in 1 year. If you're on the accruals basis, then actually you're going to use those capital allowances the same as a limited company. If you're on the cash basis, which many small sole traders are, where you're just listing basically what went in and what came in, what went out for tax purposes on your tax return, you're also allowed on the cash basis then to take things like laptops and deduct them 100%. So same thing applies. So it's definitely worth thinking about bringing that expenditure forward into this year. So yeah, worst time to do it would be, mid-April. You'd be like, if I'd done that a couple of weeks ago, actually, I could have reduced my next tax bill. You're still going to get relief in the next tax year, but why would you not want it immediately? So a lot can change in that period. So do it as early as possible. Now, talking to the cash basis while we're here. So if you're a sole trader, additional tip with this is that, because people often say to me, and I see it in YouTube comments on our YouTube channel quite frequently, is people will say, well, I'll just go and buy a load of stock every year. Now, if you're a limited company, because of the way the accounting rules won't work, any sort of unsold stock wouldn't actually reduce your profits or your tax bill. It sort of sits offside until you sell it later, and it's sort of brought into account then. And if you're using accrual accounting for your sole trader or partnership, then the same applies. It's not going to save you any money. But so specifically, if you're on the cash basis for a sole trader partnership, that kind of thing, then you will likely think about doing this. So you could actually do that. You could buy a lot of stock or buy a lot of expenses and pay for stuff right now before the 5th of April, and it's going to reduce that next tax bill. The caveat to think about with this is that if you want to get a mortgage and you're aiming for a certain amount of income, that's great for a tax result because it's going to lower your profits, but it's also therefore lowering your provable income. So it is a balance. You have to think about all those different factors. But bringing forward any investment now is a really good thing to do. And you'll see this like councils and all sorts of people do it. They're either using up budgets or they're doing it for, because they know that it's a good time to kind of look at it. So yeah, just think about doing all those kind of things. Now, slightly boring one, but I am going to talk about it, is pensions. So if you're thinking of doing a pension contribution, now there's a couple of ways of doing this. If you're doing it personally, quite often, and the normal scenario on most pension schemes is when you pay into them personally, you get a tax top up in the pot. So that they claim 20% to your pot of tax into your pension pot. Now, if you're in the higher rate of tax, so you're sort of that 50 grand upwards, and you're paying, normally 40% income tax, or around that for dividends, then you making a personal contribution can actually get you a tax refund or a rebate in your tax return because of the way it interacts. It's a bit complex. I'm not going to go into too much detail, but know that it's a good idea generally in that circumstance to be able to pay if you're going to make pension contributions, make it, and it can actually benefit you a little bit in your tax bill. It can impact, it really does make a difference. Now, the thing I would say about this, though, if you're a limited company, you probably won't want to make those contributions personally, because in order to do it, you have to draw it from the company. So you'd have paid corporation tax and you've paid dividend tax or income tax to then top your pension up, to then get more income tax back. And in a lot of circumstances, it just doesn't work out very well. Again, it's very dependent on where you are, but the more general, most common thing is that from a limited company point of view, you would consider making it what's known as an employer's contribution. So you'd look and say, my company is going to make a contribution to me as the employee into my pension pot. And that can have a massive tax impact for the company. So normally in a small business world, really, the company is almost you by extension. So any benefit of the company is a benefit to you. So it's quite frequently that's the way it's done. But you do have to consider it. So just think, if I want to contribute to a pension, I need to think about it. There's also a limit every year of the amount you can do. Now, for your average person, it's quite substantial, £60,000. And you can bring forward, in most circumstances, unused allowances from the previous year. But there's still, a cap and a time limit on how far you can bring them back. So just think about, if I do want to make a pension contribution, it's probably a good idea now. Again, if your year end for your limited company is the 31st of March, it's a good time to do it, because you need to physically pay those contributions before then to get the tax relief and bring that corporation tax bill down, your main tax bill. So anyway, pensions, boring, important, very good for tax. So have a look at those things and just see if they're for you. And that one, definitely, if you're thinking of investing in a pension, you might want to get some regulated financial advice. And oddly, as a limited company, there is some potential tax deduction for the advice you would get. So have a look at that and just investigate. Now, for limited companies, while we're on that subject, a couple of small things. Have a think about your mileage. So every year, your mileage, you can do 10,000 miles at 45p and then it's 25p thereafter. Those allowances reset every year. So again, if you're doing any final last bit of mileage, tiny tip, maybe there's something in there for you. But the other one that gets used quite often is trivial benefits, and annual functions. So we've done various podcasts on these, but basically there's an allowance each year that says you can have, basically a Christmas party or a couple of events over a year, and there's £150 a head allowance that's allowed for that. It's more detailed than what I'm telling you in this video, but you can go listen to the other things for the detail. But just know that allowance resets with the tax year, as does trivial benefits. So trivial benefits is a way that you can effectively get the odd £50 gift from your company. And again, that one's got a ton of rules. Go and check out the other videos and podcasts. But that allowance, which for directors is capped at £300, is reset as well on the 5th of April. So again, you might, if you're like, I haven't used my whole 300, you can't go and just randomly spend 150 quid because you'd break the rules. So go and look at the rules and make sure. But there might be a £50 gift that you could have this month that you might otherwise have not done, and that will help squeeze some tax efficiency as well. Now, a couple of other random ones. The most boring tip of all time, you see in every single video and every single blog that's written on the internet, but I've got to talk to you about it because otherwise it would be remiss of me, is ISAs. So ISAs, they're tax-free products you can put money into, and what you earn off them is going to be tax-free. Then they do serve a space, they're really good. But for a lot of people who don't really earn a lot of interest, just a reminder that you can earn, for most people, £500 to £1,000, depending where you are, of interest tax-free using a separate allowance. So you've got to weigh up, actually, when I go to invest my money in my bank accounts, is it better? Am I going to get a better interest rate on an ISA, which isn't always the case, versus another interest one, which technically is taxable over here to the left, but if I put it in my ISA, it wasn't, but I'm getting more interest off this one? You've got to weigh that up. I can't give you investment advice. You can do that research. I'm sure Martin Lewis or somebody has an answer to this, but I'll weigh up the two. But if you've got decent money and you want to kind of park it outside of tax, or you're thinking there's something known as a stocks and shares ISA, which is a nice wrapper for putting these things in. The bunny is there for the podcast if you're not watching this on YouTube. So it's just the term, the wrapper. You put it in there, and you could potentially get your growth and everything tax-free as well. So there is benefits, but it's just a bit of a boring tip. But again, consider that if you've got money swilling around and you want to do something with it. Now, we're talking of excess money swilling around. This one's more an inheritance tax thing. Now, as business accountants, we don't get really too involved with inheritance tax. It's normally in the realms of financial planners and people like that. But there is, if you've got some excess money, there is a gift allowance every year that you can gift people, and it takes outside of your estate. So it's not going to directly affect any tax bill now, but it's getting money out of you, basically, for when you die. It's not going to go towards the estate. So think about doing that. And again, you can just Google that and you'll find out the various different benefits of what you can do there. But it's worth a point in this checklist. Now, talking of random things that are worth a point in the checklist, child benefit. So child benefit doesn't get talked enough from a business owner point of view. There are a lot of people with kids that have businesses, and child benefit has been changed. So the way it works is if you're in a household and one of you is earning over £60,000, you start to pay what is known as the high income benefit charge. And that person has to basically pay some of the child benefit back on their tax return. That's the mechanism for collecting it. And that can be when you get to 80,000, that can mean that it all comes back. Now, in the small business world, quite often you'd have moved into, if you're earning those kind of incomes and there's a household like that, you'd have likely moved into a limited company and likely be efficiently splitting your tax across the various people in the allowances, using salary, using share structures, doing a bit of work for the company, all these things that are quite legal and quite normal tax planning, just arranging your affairs, if you like. Now, so you don't often run into the child benefit because the weird system means that you can have 49,999 on two of you, so nearly 50k. Or in this case now, I'm talking about the old limits, 59,999. Although again, it wouldn't be the best tax planning on both of you, and still retain the income of the child benefit in full. Whereas one household with 85,000, say, and the other person earning zero, has to pay it all back. It's not a fair system. The government looked at changing it and they said they were going to, and then they kind of looked at it and went, yeah, we're just not, because I think it's too complex to try and figure out. There is a way probably of doing it, but nobody's figured it out. And the last thing we've seen at this moment in time, at the time of recording, is they weren't going to change that. But anyway, this isn't a podcast about child benefit. I just want to talk to you about the reasons why, even in that scenario, it might be worth claiming. So consider claiming. The reason being is you can say, there is a form online to say, I want to claim, but I don't want the money. And the reason that's good is that it might, particularly if the person not working is the primary childcare, or maybe they don't earn enough, you can get state pension credits. So it's definitely worth registering that, or thinking about registering. I can't tell you whether in your circumstance it's worth registering, but it's definitely worth thinking about it. And the other thing is that and I didn't know this until more recently, and I've seen this in action, is if you're not in the system as such, when your child turns 16, they might not get their national insurance number sent automatically, and that's quite a big thing. So I think it's still worth considering doing, even if you know you're going to have to repay it back. You could also argue there's a cash flow benefit to getting paid the money and then having all that time, because you pay it with your tax bill later. So there is, in theory, a cash flow advantage to having the money. You could potentially put it in an interest-bearing account and then pay it back. I know it sounds odd, but that's potential. But you don't have to take the money. You can also note that you don't want it being paid to you. So have a look at that, investigate it. And that is almost it. So if we just recap very quickly, using your personal allowances, seeing if you've got any gift aid donations to make, consider marriage allowance if it's appropriate. Consider using your capital gains annual allowance, that £3,000. Consider, big one for the business owners, consider bringing forward any expenditure, particularly if you're on the cash basis as a sole trader, or it's big equipment and what's known as plant and machinery, which sounds like big diggers, but it can mean laptops, can mean all sorts of random stuff, actually. Consider bringing that expenditure forward. And then if you do need to make pension contributions, get on that quickly. They need to be physically paid. Limited company owners, think about your trivial benefits, think about your director's payroll, think about your dividend allowance. We didn't talk about that one, but it's only £500. But if you have got some money on paper and you haven't taken anything from the business, you've got no other dividends, your dividend allowance of £500 could be quite good. Consider your ISA allowances, as we said, and other tax relieving investments. Didn't talk about them in this video because I'm not a big fan, but it would be remiss of me not to mention that there are some really good tax, from a tax point of view at least, investments you can make that will give you tax relief in your tax return. And I have seen some clients do this quite successfully, but they are high risk investments, so you definitely need to get advice on that one. But there are schemes that allow you to buy shares for decent tax relief in companies. Consider gifting excess money. Talking of excess money, think about your child benefit, and as we said at the beginning, keep good records. That's it. If you have enjoyed this show, that hopefully is going to get you some tax savings. So go and have a look. Last minute dash. I know it's not everybody's top of the list, but you could save some decent money by doing these things. But please do share this information with anybody you think needs to know. And if you've enjoyed the show, if you can make sure to subscribe via your favorite app, wherever you're getting it from. I know most of you come through Spotify. We are also sending these to YouTube now, just for fun, in case you wanted to see it. One of the things I love about our main YouTube channel over at Heelan Associates is that we get to interact with people. It's it's a very interactive channel. We can go in there. We're always looking at the comments, always responding. Try and do that at least once a week to make sure we clear everything out in there. But the podcast, we don't necessarily have as easy avenue. So it's over on YouTube. You can drop in the comments there. So please do, typical YouTube thing, like and subscribe on that channel would be really, really cool, and interact with us where you can. And also, if you do get 2 moments to review us on any of the apps like Spotify and everything else, that'd be fantastic. For more business insight and tax tips, be sure to connect with me and my great team on all the social media channels, including, of course, YouTube, TikTok, apparently, Twitter, Facebook, Instagram. We do a lot of great conversations on Instagram, actually, in the DM. So thanks for everybody that connects with us there. And you can also sign up for our 2-weekly HeelanHub Herald, which is an email direct to your inbox every 2 weeks. And that contains tax tips, insight, this checklist, for example. If you go to HeelanAssociates.co.uk, our website, scroll around, you'll get a pop-up, stick your email in there. You'll get them every couple of weeks. That's there. As I mentioned before, if you want to keep good records, HeelanAssociates.co.uk/0 for an amazing deal on getting yourself a Xero license. And if you do want to get in touch about the podcast and you don't want to use YouTube or DMs or anything else, you can just email us direct, and that's info@HeelanAssociates.co.uk. That's it. Have a profitable and tax efficient week and at the end of the tax year. And I'll see you the other side of the tax year, most probably, or I don't know, we might get another show before the end of the month. We shall see. See you on the next one.